Hi guys, a very good morning to all of y'all. Hopefully my screen is visible. Okay. So today what I have planned is to do a September-December 2023, which is Jacinta code, right? So our plan would be is to complete this entire question, right? This Jacinta code, which was tested in a section B type of question. Okay. So also before I start off this question, I would like to tell y'all or I would like to inform y'all where do we stand in terms of our entire question paper, right? So far you all would have seen that we went through consolidation, which was 30 mark, and after we did two or three questions, which is related to ethics, which is for your 20 mark, right? So now what we need to look is we are focusing on our question number three, which is tested for 25 marks. Okay, here it is. Can you all see this? Can you all see this? This is being tested for a 25 mark. Normally, 25 marks are your question number three, right? So far, the examiner does not specify us, right? He does not tell us which standard is being tested. It could be either a minor standard, it could be a major standard. So far, examiner has not given us a clue, right? So what I would request, what I would ask from y'all is when y'all are attending section number B, right? Make sure that at least y'all have 50% of the overall standard knowledge, right? 50% of the overall standard knowledge so that y'all are able to tackle section B questions, right? The entire question will be for multiple standards, right? For multiple standards. So make sure that at least y'all are aware of 50% of these standards, right? So that y'all are able to ace this paper. That's it. That's all I need to tell y'all. That's all I need to tell y'all. Where do we stand? Okay. So Jacinta Co is what I'm going to look at. Jacinta Co is what I'm going to look at. Let me go and read the requirement. Let me go and read the requirement. Right? Here it is. Here it is. Okay. So the examiner wants me to explain, right? What does he want me to explain? He wants me to explain the accounting treatment for a loan, right? There he wants me to explain the accounting treatment for a loan, right? Also, he wants me to include journal entries, right? He wants me to include the journal entries. If I fulfill these two requirements, I'm able to get 8 marks, right? So I should make sure that my answer includes an explanation of the accounting for a loan as well as the journal entries to get that 8 mark. Okay. So be confident because this is a bit easy. This is a bit easy, right? Why? Because even by simply stating the journal entries, right, you all are able to get at least 2 to 3 marks for each journal entry, right? Journal entries are simple debits and credits, right? If you all mention that, you all will be able to get at least 2 to 3 marks minimum. Okay. So by looking at this, right, you all should know or you all should be able to identify what is this standard related to, right? Always you all need to know, right? If they give any loans, obviously it is IFRS 9 related to financial asset or liability, right? If it is a loan, it either has to be a financial asset or a liability, right? Let us go and read our very first requirement to understand which category does it fall in. Which category does it fall in? Okay, before that, in your background, they have given uh, multiple, multiple details, but what we need is only a financial year end as of now, right? Which is 31st December 2006. Which is 31st December 2006, right? And now I'm moving on to our very first exhibit, right? Now moving on to our very first exhibit, right? Jacinta Co purchases, right? They purchase loans, okay? We know that this is related to IFRS 9, but we don't know whether it's a financial asset or a financial liability, right? How do I determine? How do I determine? How do I determine? Well, it's a question mark. Okay, how do I determine? It's a question mark. Let me keep it quite simple for. Let me keep it quite simple. Hopefully, I'll know the definition of financial asset. Hopefully, I'll know the definition of financial asset, right? Financial asset means, right? You all do investments, right? You all do investments with an intention to collect contractual cash flows. Can you all see here? They are expecting to receive contractual cash flows. So this is how I determine whether this is a financial asset or a liability, right? By using this particular purchase word, and also they're planning on receiving contractual cash flows. Okay, this is how I determine it's a financial asset, right? They are purchasing a loan, right? They are purchasing a loan with the intention of collecting contractual cash flows, right? So obviously this is a financial asset. This is a financial asset. You okay? This is a financial asset. Okay. So once you determine that it's a financial asset, right? They have multiple methods of valuing, right? But in this, examiner has specifically chosen amortization cost table model, right? Examiner has chosen amortization cost table model. Okay. And also they are speaking about something known as credit impaired. Right? What does this mean? What does this mean? Obviously, we went and invested, right? We went and invested in some loans, right? Those loans contain bad debts, right? Those loans contain bad debts. What do they contain here? See, we are expecting to receive some cash flows, right? These are uncertain, right? These are uncertain. That is why we have some impairments or bad debts related to that loans, right? This is all that you all need to know. Identify whether it's a financial asset or liability, right? And since this is an impairment, right? Since this investment has impairment, right? Impairment means that we need to treat it as bad debt, right? Or we are not sure whether we'll receive those contractual cash flows or not. Okay, that's it. That's it. That's it. Okay. Now I would not read this remaining two lines. I would not read this remaining two lines, right? Why? You all know that you all are using amortization cost, okay, and you all know that these are financial asset, right? So under financial asset, you all can go and speak about the initial treatment or initial recognition and the subsequent recognition, right? You all can start off. Here it is. On 1st January 2006, right? They bought a remaining term of 4 years. So that is why I assume that is why I'm able to identify why they have gone and put it under amortization cost model, because this is for long term. See here, this is held for long term, 4 years, right? This is held for 4 years. Okay, no problem. Jacinta Co paid cash, right? Obviously, when you all are buying a financial asset, you all need to give cash, right? You all paid cash of 32 million, which is equivalent to its fair value. No problem. They have bought it at the market value, right? So here we are. Here we are. Initial recognition would be, guys, initial recognition would be simple, right? We bought our financial asset by paying cash. So this is the journal entry at 32 million. At 32 million, right? At 32 million. Okay. At 32 million. That's it. That's it. You all need to know in terms of your initial recognition. Okay. That's it in terms of your initial recognition. Okay. Now let me go and read on. Jacinta Co correctly calculates, right? They have correctly calculated something called the loss allowance. Okay. Loss allowance. So, okay. So what does this loss allowance mean? What does this loss allowance mean? Well, recently, I would not say very recently, IFRS 9 has told us something, right? IFRS 9 has told us something or bought in something called as the ECL model, right? ECL model. What does this ECL model say is, rather than waiting for the bad debt to occur, okay, rather than waiting for the bad debt to occur, what you all could do is you all could start creating an allowance, right? Rather than waiting until that certain bad debt occur. What does the expected credit loss model or ECL model say? Is that you all can start creating an allowance by expensing, and a corresponding entry would be transferred to your loss allowance. It's like a simple provision, right? And once, okay, and as soon as you get the signal, from your other party saying that we are at a bad debt, we are not able to pay, then what you all could do is you all could debit your bad debt expense and then credit off the investment or the financial asset. This is what the ECL model says. This is what the ECL model says. What do they again say is, rather than staying, rather than simply staying until the bad debt occur, right? What you all could do is you all could start creating an allowance, right? This is step one. And as soon as it occurs, when you all get the confirmation that the other company or the payable company is in bad debt, you all can create the bad debt and credit the relevant investment. Right? This is what the ECL model says. This is what the ECL model says. And so far they have done it correctly. So far they have done it correctly. Right? So far they have done it correctly. Now let us move on to our subsequent measurement. Let us move on to our subsequent measurement. Right? Here it is. We are here. Right? Okay. So at 1st Jan 2006, the financial year beginning, right? They were planning on receiving these cash flows. You see, expected cash flows. These are expected. These are not certain cash flows. These are under expectations, right? For the 4 years, 2006, 2007, 2008, 2009. Okay. So give me a minute. Give me a minute. Now we only did the journal entries, right? We only did the journal entries. Let us go and explain also. Let us go and explain also. Right, here it is. If I would start off, I have given you all some pointers. What I want you all to do is, as soon as you all finish this session, right, you all could start creating your own answers. Right, you all don't need to copy mine as usual. What I say is, don't never copy mine, never copy the examiners. You all can write whatever you all feel by grabbing any of our answers. Right. Okay. So what does IFRS 9 say? Here it is. Here it is. IFRS 9 states that to book an expected loss allowance, right? Here, see, rather than delaying till the event occurs, right? Rather than waiting until the bad debt occurs or until you all get the information from the other party, right? What you all could do is you all could start creating your loss allowances, right? You all could start creating your loss allowances. Why? Why? This is something related to prudence concept. This is something related to prudence concept. It's like a safety measure, guys. It's like a safety measure. Rather than waiting until they confirm, prudence says is, right, it acts like a safety net. Right? What you all could do is, before the risk happens, you all could be ready. Right? That is what it means. So if you all mention this, you all will be able to get 1 mark. Right? You all could speak about the expected loss model. Right? And your prudence concept, you all will be able to get your 1 mark. Okay. And also, here it is, right? Obviously, it's a financial asset, right? You all know financial assets are supposed to be recorded at fair value. Okay. So you all could speak about that as well. Financial assets are always recorded at fair value initially, right? They are recorded at fair value. But see, this is not a normal financial asset, right? Why this is not a normal financial asset? Well, here it is. They have purchased a financial asset which is credit impaired, right? Which contains bad debt. Which contains bad debt. They have gone and purchased a credit impaired investment, right? Why would they do so? Why would they do so? Here it is. Why would they do so? Right? For this, I need to give you all a small example. Small example. For example, right? There are three companies, A, B, C, right? C company is you, right? You are C company, right? What happens is A needs to pay B company, right? Okay. A is needed to pay B company. Okay. But since I guess, since A was telling that B, right, since they at the current moment they are having some liquidity issues, right? They are in bankruptcy, they are not able to pay B, right? So what B does, since they are not able to get off the cash, they are not able to get their contractual cash flows, they sell it to you. You see, they are selling it to you, right? So my question would be is, why would you go and buy, why would you go and buy companies debts, right? Why would you go and buy companies financial assets or receivables? Why would you go and buy when they are at bad debt? When they are at bad debts, why would you go and buy a company? Well, sometimes we might know the actual potential, right? But now obviously they are facing credit issues, so they are not able to give contractual cash flows, or they are not able to pay off their loans. But in the future, what if it turns around? What if it turns around? What if they recover? What if they have a proper profits, right? Because of the profits, they are able to give us the loans plus the interest. Obviously we are going to benefit, right? We are going to benefit rather than B, because why? B sold it to us. So who's the beneficiary now? It's us, right? And also since it's impaired, right, we can get it at a cheaper cost. We can get it at a cheaper cost, right? Compared to the market value, we can get it at a cheaper cost. That is what we mean by impaired financial loan, right? Compared to the market cost, you will get at a cheaper cost, because this includes bad debt. You are not sure whether you are able to recover or not. But some companies like us, right? Some companies, what do? Is they go and buy these bad debt investments. Why? Because they know the actual value. They know the real value of that asset, right? They know that real value of that asset. So here it is. Here it is. Okay. Here it is. Right. We are supposed to record them at net amount, guys. We are supposed to record them at net amount, right? And also this will be sold at a lesser price compared to the market, right? That's what I told you all. Why they are selling at a lower price? It's simple. The reason they are selling it at a lower price is because that asset is an impaired asset, right? That has bad debts. That has bad debts, so people would not buy it at the actual market price, right? Also, when we are recording this asset, can you all see here? When I recorded this initial recognition, I never meant and mentioned impairment, right? Did I go and do some impairments here? No, right? Why? Because this amount that I'm paying as cash, this amount that I'm paying as cash already includes the deduction of allowance. Here it is. Here it is. Here it is. Here it is. That is what I've explained. You are not required to deduct or calculate the loss allowance. Sorry. You see, we are not required, right? We are not required. Give me a minute, guys. Let me connect my plug. Let me plug in my charger. So what y'all need to know is when y'all are going and buying a company which is already impaired, right? They would be sold at a lesser price, right? They would be sold at a lesser price. When they are sold at a lesser price, guys, did you all think about that existing impairment allowance? Right? That's what I'm speaking here. That is what I'm speaking here. Can you see? We are not required. We are not required to calculate the loss allowance. Why? Why aren't we required to calculate the loss allowance? Since they are already included within the purchase price. They are already included, right? It includes the loss allowance. Can you see this 32 million already has been subtracted? It has already deducted the loss allowance, and only we have got, or only we have paid the cash. Can you see? This is why we have paid 32 million. This 32 million is after the deduction of loss allowance. This 32 million is after the deduction of loss allowance. Okay. So what I want you all to do is under initial recognition, as soon as you all find out this is a financial asset, go and record the double entry. Step number one, right? After that, you all can speak about the expected loss allowance, right? Related to prudence concept. What does it say? Rather than waiting until the exact loss or until the exact bad debt occurs, what you all could do is you all could start creating allowances. And whenever it occurs, then you all could go and deduct it from the investment, right? This is being ready for your risk, right? That's what prudence says. What does prudence concept says? Uh, Prepare yourselves beforehand or before the risk occurs, right? Before the bad debt risk occurs, prepare yourselves, right? After that, I have spoken, this is a financial asset. Financial assets are required to be initially recorded at fair value, right? And this particular financial asset is already at net, right? Is already at net amount. Why it is already at net amount? Because they have already deducted this loss allowance. You do not need to go and recalculate loss allowance. Okay, this has been already deducted in this. Okay, this has been already deducted in your financial asset. I don't want you all to go and recalculate. Here, see, they are not required to deduct or recalculate the loss of allowance. Why? Since this is already included within the purchased price. Okay, that's it. That's it in relation to your initial recognition, right? Then after we move on to our subsequent measurement. After we move on to our subsequent measurement, right? What does this say? What does this say? Let us go and read on. Here it is. Obviously, you all know, as soon as you all record your initial method, right? Initial measurement, you all are going to do amortization cost model. For what? For what? Because you all are supposed to receive incomes, right? You all are supposed to receive interest income as well as contractual principal payments, right? And here it is, the credit adjusted effective interest rate. It is credit adjusted, right? Normally, you all would see under IFRS 9, you all would only get effective interest rate. But since this is an impaired loan, right, you all need to adjust the credit. You all need to adjust it according to your credit. What's the amount? 3.9% per annum. 3.9% per annum. Okay, here it is. Here it is. So this would be your amortization table, right? This would be your amortization table. Okay. This would be your amortization table. This would be your amortization table. What does it include? It includes your opening balance, right? It includes your opening balance. How much was your financial asset? It was 32 million, right? It was 32 million. And what was your effective interest rate? Your effective interest rate was 3.90. It was 3.90, right? So your interest income would be for the year, obviously it would be 32 million, right? At 3.90 interest rate would give you 1.248 million of interest income, right? It would give you 1.248 of interest income. Okay. And obviously your contractual cash flows are 8.8 million respectively for your next 4 years, right? So that is what I have mentioned here, 8.8 million, right? So opening balance plus your interest income minus your cash received will give your closing balance, which is 24.448 million, right? This, of course, I don't need to explain to you all at all, right? This is a simple amortization table that you all are aware of. You all are aware of. Okay. And also what you all could do is they want a journal entries, right? You all can speak in terms of interest income and your cash flows, right? You can speak in terms of your interest income and your cash flows. Interest income is an income, right? So it's credit and it will debit your financial asset. Cash received will increase your bank and obviously it will reduce your financial asset. Why? Because he has paid us the cash. He has paid us the cash that he is needed to pay, right? He is needed to pay. Okay. So this is it. This is it in terms of my subsequent measurement. This is it in terms of my subsequent measurement. Here, see, I've gone and wrote what I have done here. I have gone and wrote how did I arrive at this calculation. Here it is. Subsequently, they are supposed to book interest income. No problem, right? What rate will I be using? Effective rate after adjustment, right? Which is 3.9%. Or simply here, see, credit adjusted effective interest rate only I'll be using to calculate interest income, right? And what is the method that I'm going to use? I'm going to use amortization table, right? So the interest income for my December would be, you see, simply I copy pasted it, right? And the carrying amount would be 24,448, right? This is how I did the calculation, and the same thing I just included in words, right? The same thing I included in words. This is how I came into my subsequent measurements. Okay. And also, let me tell you all, why did I only do it for 31st December 2006? Because, can you all see here? They only want it for 31st December 2006. This question is only related to 31st December 2006, which is the current financial year, right? They don't want you to go and do the other subsequent years. No, not at all. Okay. So for your subsequent measurement, guys, what I would tell you all is simply explain your calculations, right? Include the journal entries. Include the journal entries. J dot E. Include the journal entries. You all will be able to get your mark, right? Obviously, interest income will increase your income, as well as it would increase your financial asset, right? And on the opposite, because you are receiving cash, you all need to increase your bank and reduce your financial asset. Okay. 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 Finally, we are left off with our very last one. We are left off with our very last. Here it is. Here it is. During the year ended 31st December 2006, which is our financial year end, right? 8.8 million was collected. Obviously, this was under expectation, right? This was not your actual cash flows. This was under expected. So we were able to actually collect it, right? So that there is no problem at all. We were able to collect that 8.8 million, right? We were able to collect that 8.8 million. There was no problem at all. We were able to collect 8.8 million actually, right? No problem. We received it. We expected 8.8 million. We received also. No problem at all. But here comes the best part. Here comes the best part. Here, see, at 31st December 2006, the credit worthiness has improved, right? What does this mean? What does this mean? Here, see, you all were expecting their credit worthiness earlier was they were only able to generate 8.8 million. Okay, that they were only able to generate 8.8 million worth of contractual cash flows. Okay, but now since they have improved, they are able to generate cash flows of 10 million each year. Can you see here? So I guess the company is performing well. Company is performing well. Company is performing well. So they are able to generate. Company is performing well. Right? This is why they are able to generate, rather than giving us 8.8 million, they are able to give us an addition of 1.2 million each year. Right? So for the final 3 years, from 2007 to 2009, they are able to give us 10 million each year. Right? 10 million each year. So what you all need to do is, right? Earlier, what happened was, they have gone and done loss allowance, right? They have gone and done loss allowance, right? Why would they go and do loss allowance? Why would they go and do loss allowance? They would have thought that this particular company is under bad debt, right? And they are not able to give us cash, right? So we went and created loss allowance under the prudence concept. Here it is. We went and created loss allowance under the prudence concept. Why? Because we initially thought that they are not able to repay their loans. right? They are not able to repay their loan. So that's what we are not able to receive cash. But now tables have turned. Now tables have turned, right? Why? Because now their credit worthiness have improved. They are able to pay even 1.2 million more each year, right? They are able to pay, right? Their profits are good. So therefore, whatever the loss allowance that we have created needs to be reversed. Whatever the loss allowance that has been created, we need to reverse. Why? Again, let me tell you all. Initially, we thought they were loss making, right? So we went and created loss allowances. We went and created something called the expected loss allowance, right? But now their credit worthiness have improved. Because of that, they are able to give us 10 million cash each year, right? So this loss allowance needs to be removed or reversed, right? Because obviously, right now they are not going to be at bad debt. They are able to pay their loans. Then why do you need a loss allowance, right? Loss allowance was initially created because they were in a bad debt situation, right? But now they are able to create. Then why do you need an allowance? Why do you need an allowance, right? That is why we need to go and reverse it. That is why we need to go and reverse it. Here it is. Here it is. Here is the point. Here it is. Due to the improvement in creditworthiness, right, they are required to reverse the previous impairment allowance. Why do you all reverse it? Why do you all reverse it? Well, it's quite simple. The reason that you all are reversing it is, guys, because earlier you all thought they are not able to pay all. They are not able to pay all. Right? Now they are able to pay. Right? Earlier, not able to pay. Right? Earlier they were not able to pay. Now they are able to pay all. Right? When they were not able to pay or earlier, right, you all ended up creating impairment allowances. Why? They were not able to pay, so you all went and created losses. Now you all need to reverse them back. You all need to reverse them back. Why? Because now their credit worthiness has improved, right? How do you all calculate this reversal? How do you all calculate this reversal? Here it is, right? This reversal can be calculated. It's the difference, guys. It's the difference between the original present value and the revised present value, right? Here it is. How to calculate, how to calculate reversal of allowance, right? How to calculate it. Here it is. It's simply the difference between the original present value and your revised present value, right? So, okay, let me tell you how they all do it. How they all do it. Here, see, this was before, right? This was before. Okay, this was before. And what were your contractual cash flows? Obviously, you all are done with 2006, so you all don't need to consider that at all. 2007, 8, 9, 3 years had 8.8 million, right? This was your contractual cash flows. Contractual cash flows. Okay, this was your contractual cash flows. 8.8 million each. 8.8 million each. Okay. So you all know how to find the discounting factors. It's 1 divided by 1 plus r to the power 0 to the power n, right? So what you all need to do is simply 1 divided by 1.039 to the power 1, right? Simply copy paste this here, right? This is your second year. Since this is your second financial year, this will be 2. Copy paste that here. This would be 3. Okay. And your present value would be, right? You all were supposed to get 8.8 million is the expected. For 1 year, the present value would be 8.46 million, right? Similarly, second year also you all were supposed to get 8.8 million, right? The present value of that is 8.15 million in year 2, right? And in year 3, you all were supposed to get 8.8 million. right? The actual present value of year three in today's term is 7.84, right? So your total present value would be, your total present value would be, how much? Sorry, awesome. My present value, right? My present value before, right? Or at the date of what do you call impairment allowances would be 24.46 million, right? It was before the reversal. Before the reversal, it is 24.46 million, right? After, after means what after I mean is, right? Now the company is able to repay. How much they are able to repay? They are able to give us now contractual cash flows of 10 million each. They are able to give us contractual cash flows of 10 million each. That means after their approval of credit worthiness, they are able to give us 10 million each. Right. So what I would do is the discounting factors obviously would remain the same. Right. The discounting factors obviously would remain the same. Right. And now I would go and recalculate. I would go and recalculate the present value of the revised one. The present value of the revised one. 10 million is I'm going to is my revised cash flow, right? So the present value of the revised cash flow for the year one would be 9.62. The revised cash flow of the year two would be 9.26, and the revised cash flow of year three would be 8.91. Right? So my total present value would be is total total present value would be is 27.80, right? So what I need to do is, if I need to calculate something known as the impairment gain, if I need to calculate something known as the impairment gain, right, I would see the difference. I will see the difference between the earlier present value and the latest present value, right? So the difference is, or simply I could take is the difference between this and this is something called as the impairment gain, right? Impairment gain. Okay. The impairment gain. Okay. How do I go and record this? Here's the double entry. Here's the journal entry. How do I go and record this? Here's the journal entry. Right. The journal entry would be, this is an impairment gain, right? Impairment gain is a income. It's an income, right? Debit impairment gain, and I need to go and reverse it, right? Where do I go and reverse it? I need to go and reverse my loss allowance. I need to go and reverse my loss allowance, right? So this is it. This is it. This is it. Okay. This is it. What y'all need to know? What y'all need to know? Y'all need to speak about the initial recognition, right? Speak a bit of IFRS financial asset, right? And how they'll record it, right? Speak about loss allowances, right? Speak about loss allowances. Why do you all need to prepare it beforehand, right? Also, you all can speak that we are recording this as net, right? At a net. Why? Because already the amount that we are paying, or already the transaction or the purchase price includes the loss allowance. We are not needed to again go and record it, right? That is why. After we move on to our subsequent measurement, right? We move on to our subsequent measurement. Examiner has only asked for the year 31st December 2006. So we have to speak about the P&L and the cash flow, right? And the SOFP, right? If you all speak about these P&L, cash flow, SOFP, okay, and include your journal entries, that will also give you all mark. And whatever you all have done here, right? You all need to explain that as well. At what is the rate you all are using, at what rate it's an effective rate or not, you all need to explain it here, right? After that, we go and speak. After we go and speak, obviously, you all know, right? The tables turned. The tables turned. Here it is. Table turned, right? Because of the tables improved, right? Because of the tables improved, you all need to reverse your impairment allowance. You all need to reverse your impairment allowance, right? How do you all do it? How do you all calculate? Simple. Take the present value of the old one, right, at 8.8 million cash flow. Take the present value of the new one due to the improvement, which is 10 million. Identify the difference. That difference needs to be taken to your P&L and it needs to be reversed from your loss allowance, right? This is it. This is it. Okay. This is it. This is it. Okay. Give me about 2 minutes and let us start our second question, right? Okay, guys. Hopefully you all have understood our first requirement. Hopefully you all have understood our first requirement, right? I would ask you all to redo this, right? I would ask you all to redo this. And now let us move to our next requirement, which is B, right? Rather than moving to B part one, which is 10 marks, and it's an easiest one, right? I would like to move into the 7 mark question. And after later, we could move on to the B part first requirement. Okay. So here, see, here also they want us to explain and they want us to include calculations, right? On what they have gone and sold some inventories and they want us to show how do we account in our individual financial statements of Jacinta Co and subsidiary, right? Here it is. And also they want to show us how do we account in our consolidated statements. So it's two simple stuff, right? One console and number two individual, right? They want us to show in our consolidation as well as individual. And we need to speak under two perspectives. We need to speak under two perspectives. One would be your Jacinta Co, right? And the other one would be the subsidiary company, right? Subsidiary company. Okay, that's being tested for 7 marks. Let us soon finish. Let us soon read it. Try to identify. Okay, for that we need to get some background information as well. For that we need to get some background information as well. Jacinta Co is the parent company, right? Jacinta Co is the parent company. Okay, obviously they are the parent company. Okay, they deal in telecommunications sector, right? Their business is majorly specialized in telecommunications sector, right? And their presentation currency, the presentation currency of the parent is dollar, right? So when you all see this, right? Hopefully something should click your IAS 21, right? IAS 21. When you all have multiple currencies, when you all have multiple currencies being involved in your business, right? IAS 21 kicks in. IAS 21 kicks in. Okay, IAS 21 kicks in. Okay. So Jacinta Co is a parent company, right? On 1st September, parent is buying parent sold inventories, right? Costing 1.35 million, right? Let me write this also here. Let me write this also here. Parent's functional currency is the dollar. Parent's functional currency is the dollar. And the subsidiaries functional currency is the euro, right? Let me write that as well so that I don't get confused. Okay. Because I need to speak. The reason why I told is I don't want to get confused because I need to speak in individual statements. I need to speak in terms of my individual Jacinta Co as well as my subsidiary. So I need to know which functional currency they are using. Okay. So the parent uses dollar, right? He has sold for 1.35. He has sold for 1.35. He has sold for 1.35, which was costing 1.35 at $2 million. So that means I guess 0.65 million is the profit, right? 0.6 million is the profit. There is no right of return, right? That means risk and reward is transferred to customer, right? This is what it means. This is what it means. There is no right to return, right? That means all the risks, all the rewards are transferred to your customer, right? Here it is. Here it is. So this is how it's a very easy peasy question. It's a very easy peasy question, right? You all are able to do this. You all are able to do this. Don't worry at all, right? You all are able to do this. What you all need to do is you all first need to speak about the individual statements, right? Speak about two parties. Speak about two parties. What is a Jacinta Co? The other one is the subsidiary, right? You see, since there is no right to return, the risk and rewards, right? The risk and rewards are transferred, which means we can recognize revenue. Obviously, you all know IFRS 15. What does IFRS 15 states? What does IFRS 15 states? If I need to record revenue, the risk and reward has to be transferred, or my performance obligation needs to be met, right? If I need to meet that, my risk and reward has to be transferred, right? So since here it has, they have clearly mentioned that they have transferred it, right? We can recognize revenue. When do we recognize revenue? When the asset has been transferred. When the asset has been transferred, not at the date you receive cash. Asset was transferred on 1st September. Right? Can you see here how I'm relating? I'm bringing in the person who's giving the money. I am bringing the date and I'm relating the financial figures. You see? And when will I record it? Is it over the time or is it point on time? Is it over the time or is it point in time? It is in point in time. Why? Because this is a good, right? This is a good. Okay. This is a good. Whenever you all sell a good, at that point of time, when it's being transferred, at that point of time, your revenue will be recorded, right? How much? How much? How much? Revenue of $2 million. You see, $2 million. Obviously, because now I need to speak in terms of functional currency of Jacinta Co. Individual statements. Functional currency of Jacinta Co's individual statements. Okay. $2 million is the revenue, right? Cost of sales is $1.35. Cost of sales is $1.35. And the profit is $0.65 million, right? 0.65. Right? These all I need to speak. What you all need to speak? Speak about how do you all recognize revenue, right? When the risk and rewards are transferred, you all recognize revenue. When do I recognize revenue? I need to specify the date. Is it at a point of time or is it over the point of time? Since this is a good, you all are selling inventories. Inventories will be recorded when you pass over the control, right? And finally, you all need to speak about the figures, right? You all need to speak about the figures. You all need to speak about the figures. Okay. The revenue figure, $2 million, functional currency. The cost of sales, which is $1.3 million, functional currency, and the profits, which is 0.65 million at the functional currency, right? And finally, we are left off with something called as we are now supposed to discuss the overseas subsidiaries individual financial statement, right? Individual, right? So what will you speak? What will you speak? Here it is. What will you speak? Here it is. Here it is. Subsidiaries functional currency is the euro, right? So you all need to, obviously, if this person is selling it, this person is buying it in individual statements, right? If this person is selling it, this person is buying it. So here see, as this is in the group, they will record them in their very own functional currency, right? Functional currency, which is the euro, right? As purchases, obviously, he sold, this is a purchase, right? And when will the purchase occur? It will occur on 1st September, right? On 1st September. Okay. And how much did the purchase, guys? Obviously, he sold it for $2 million. He sold it for $2 million. Okay. He went and sold it for $2 million, right? He went and sold it for $2 million. So I need to convert it. I need to convert it. Let me convert. Let me convert this. And let me redo this as well. Let me redo this as well. Let me redo this as well. Hopefully, I'll remember IAS 21. Hopefully, I'll remember IAS 21. Right? IAS 21. What does IAS 21 say? What does IAS 21 say? Here it is. Here it is. When any of the P&L items, guys, any of the P&L items, it could be revenue, cost of sales, profit. You all need to record it at spot rate or whenever the date. You see, this is being transferred. This is being transferred on 1st September, right? You all need to use that spot rate. You all need to use that spot rate. You see, the exchange rate on the date of sale. You know, see here, this is called the spot rate. This is called the spot rate. This is called the spot rate, guys. Right? This is called the spot rate. So, what does IAS 21 say? What does IAS 21 say? If it's related to P&L items, right? If it's related to P&L items, what you all need to do is simple. What you all need to do is quite simple, right? What you all need to do is you all need to record at its spot rate, right? At its spot rate. If it's a balance sheet item, right? If it's a balance sheet item, you all need to record it at closing or opening rate, right? This was what IAS 21 says, right? Okay. So when did we transfer? We transferred this on 1st December 2006. We did the transfer on 1st December 2006. So the spot rate on 1st December 2006 would be $1 is to 1.25 euros, right? $1 is equals to 1.25 euros. That means how much would have been $2 million? How much would have been $2 million? Right? How much would have been $2 million in euro terms? In euro terms, it would have been, guys, 2.5 million. Here it is. So this is my revenue in functional currency of euro. In functional currency of the subsidiary. Functional currency of subsidiary. Right? This is the functional currency of subsidiary, which is the euro. Which is the euro. Right? And as well as I need to again now recalculate something called as my cost of sales, because I need to bring the cost of sales in the functional currency of the subsidiary, right? Because he is an individual statement now. He is an individual statement now. He is in an individual statement now, right? How much was the cost of sales? 1.35 million in dollars, right? If that is so, how much would be in euros? It would be 3 point, you see, it's 3.375, right? And how much was the profit? How much was the profit? The profit was 0.65, right? So the profit would be in my functional currency of the subsidiaries individual statements. Subsidiaries individual statements would be 0.8125, right? 0.8125. Okay. 0.8125. Here it is. That's what I mentioned here, right? As since this is not a group, right? We need to, if it's an individual statement, I need to mention it in my functional currency, which is the euro, right? The purchase date was 1st September. So I need to use my spot rate. I need to use my spot rate to calculate it or convert it into euros, right? And I need to speak in terms of my revenue in euros, my cost of sales in euros, right? My cost of sales in euros, as well as finally I'm left out with my profit also in euros, right? If you speak about this and if you are able to give your calculations, that entire mark is yours, right? You all don't need to give like this. You all don't need to give detailed calculations. Simply calculate, and simply if you are to show your workings, you all are able to get your marks, right? These all related to your individual statements. This is all that is related to your individual statements, right? This is all that is related to your individual statements. Okay. Now we move on to our consolidation. Now we move on to our consolidation, right? Which would be obviously, I guess it's about 4 marks, right? 3 marks is for individual statements. 4 mark would be for your consolidated statements, right? What you all could write, what you all could write here, see, what you all could write here, see. Did anyone come across this? It's a wholly owned overseas subsidiary. That means you all own 100%. You all own 100%, right? So you all can speak. Since it's wholly owned, we will not need to account for NCI, right? You all don't need to give your share of profits to NCI. You all don't need to give your share of profit to NCI. Yeah. And another one that we could speak, right? Another one that we could speak, right? Another one we could speak is here. See, normally when we are in the group, guys, when we are in the group, right? When we are in the group, what is required by IAS 21 group accounts, right? IAS 21 group account says that IAS 21 group account says that what does he say? Okay. He says, see, sometimes the parent's presentation currency and the subsidiary's functional currency can differ. No problem. Y'all can differ. In this term, see, parents presentation and functional currency is dollar. Subsidiaries functional currency is euro. Right? They are differing. But when you all are preparing the financial statements, you are supposed to use parents presentation currency. This is the rule of thumb. This is the rule of thumb. Okay. You all need to speak about this. Right? When you all are, it's okay, no problem. They can do their functional activities in multiple currencies, but when you're presenting the financial statements, you all need to make sure that this is presented in your parents presentation currency, right? And also you all can speak about intra-group profits, right? Intra-group profits. Obviously, you all know intra-group profits are not allowed in terms of your consolidation, right? So you all need to remove it, right? You all need to remove it. Okay. And also, if you all know, profit is whose element? Profit is part of P&L, right? Profit is part of P&L. Okay. If profit is part of P&L, we need to record it at or retranslate it at spot rate, right? Why? Because he is part of P&L. You all need to retranslate him at spot rate. You all need to retranslate him at spot rate. Hopefully you all are aware, right? Because profit is part of your statement of profit or loss, and all the statements of profit or loss items are needed to be retranslated at spot rate. So how much will we be removing from our group accounts? How much will we be removing? How much will we be removing? We need to ideally remove the 650,000. Here, see, we earned a $650,000 profit, right? We earned a $650,000 profit, right? We need to remove that. We need to remove that. Yeah. For your reference, here this has been here. Right? Here it is. This how I just here it is. You all need to remove. This will be removed. You all need to remove this. Why? Because intra-group profits are not allowed. Right? Intra-group profits are not allowed. Right? Intra-group profits are not allowed. Right? Now we're left with the last part. We're left with the last part. Okay, we're left with our last part. What is the last part? At 31st December, right? At the closing date, subsidiary still holds goods of inventories, right? Subsidiary still hold goods of inventories means they have not sold it yet. These are unsold, right? These are unsold. So obviously, you all need to value the unsold inventories. You all need to value the unsold inventories, right? You all need to value the unsold inventories, right? In group perspective, in group perspective. You all need to value them in group perspective, right? So here see how much would have been your opening inventory in terms of group. Your opening cost of sales was 1.350. Your opening cost of sales in dollar terms was 1.350. It was not me who told it, it's the examiner. Here see 1.35 million was my opening. How much would be my closing? How much would be my closing? Well, to find out that, guys, it's simple. It's simple. Can you see here? The closing of the subsidiary was 1.6875 euros, right? That you need to divide. That you need to divide by 1.30, right? If you divide that, if you divide that, if you divide that, you will be able to get the closing inventory, the closing inventory, right? Any difference between these two? Give me a minute. I guess there's some calculation problem. Right, there's some calculation problem. So 1687 divided by how much is the rate, guys? How much is the rate? 1.30 per dollar. 0.30 per dollar. Here it is. So the opening rate, opening inventory was given, right? Closing, because they did not sell. They did not sell. We need to speak from the group perspective, right? How much would have been? How much this would have been? The closing inventory in terms of a subsidiary is 1.6875 in euro terms. We need to bring that in dollar, right? Once we bring that in dollar, we get 1.297 million. The difference between this, the difference between the opening and closing would be your exchange loss, would be your exchange loss, right? Exchange loss would be 52 million, 52, right? Exchange losses are transferred to OCI. Exchange losses of group, right? Since these are group accounts, you all need to transfer them to OCI. You all need to transfer them to OCI, right? This is it. This is it. Let me check my answer, please. Yeah. Yeah. So that's it, guys. That is it. That is it. What did I speak? I spoke about individual financial statements, right? I made sure that I related to the paragraphs, right? I made sure that I related to the paragraphs. I spoke about the overseas subsidiaries, individual financials, Melville, right? In terms of euro, in terms of euro. After that, I moved on to consolidation, right? Regardless of whether your parent and subsidiary does functionals in various currencies, they need to present their financial statements in the parent's presentation currency, right? Intragroup dividends profits has to be removed, right? It would be removed at a calculated dollar price, as well as they have not sold inventory, right? They have not sold inventory. Because of that, we do a calculation between the opening dollar balance and the closing dollar balance of the group inventory, right? Any difference, right? Since this gave an exchange loss again in terms of group, right? In terms of group, will be needed to calculate or will be transferred under OCI, will be transferred under other comprehensive income, right? And also, I would like to give you all another tip, right? Another tip, which is tip number 4, right? Which is tip number 4. Here, see, IAS 1 says, you all can reclassify to PNL, right? You all can PNL from OCI, right? When there is a sale of subsidiary. Okay. What does this mean? Can you all see here? What does this mean? Let me take another color. What does this mean? Here, see. Can you all see here? This exchange gain or loss, I'm transferring to OCI, right? This exchange gain or loss, I am transferring it to OCI, right? Sorry. sorry. This exchange gain or loss, guys, I am transferring to OCI, right? I can reclassify them to P&L when they are realized, right? When they are realized, or when I sell the subsidiary, guys, when I sell the subsidiary, when sub is sold, or when this is realized, right? What I could do is from OCI, I can transfer them to P&L. I can show them in under my P&L, right? You'll go and read IAS 1, you will be able to attempt this. You'll go and read IAS 1, you will be able to go and attempt this, right? You'll go and read IAS 1, you will be able to go and attempt this. IAS 1 simply says, what does it say? You all can reclassify when that subsidiary is being sold, right? So OCI will be debit and you all need to credit P&L, right? That's how you all do. That's how you all do. Okay. So let me give you all a summary as well. Let me give you all a summary as well, right? Of standards, right? We went and studied IFRS 9, right? We went and studied IFRS 9 ECL model, right? We went into IAS 21, right? We went into IAS 21. We studied right? We studied IAS 1 presentation, right? Now we are going to study, we are left out with something known as IFRS 15, which is your revenue, right? We are left out with a revenue, right? These are your standards that you all need to study. These are your standards that you all need to study before attempting this question, right? Before attempting this question, these are the standards that you all need to study. Okay. These are your standards that you all need to study. Okay. So now hopefully that you all are able to understand this as well, right? Hopefully all have been able to understand this as well. See, the reason why I went, or why I did this individual financial statements quickly is because individual financial statements, guys, we all did IAS 21 in F7, right? The only part that I wanted to explain to you all was your consolidation, right? Because you all did not have any idea, right? That is why I explained it, right? Always remember, you all need to present your consolidated financial statements in parents' presentational currency, right? Any intergroups or any unsold inventories or any SOFP components needs to be retranslated, right? That's all you need to know in terms of question number 2. Okay. Okay. So the final question would be, guys, we are left off with a 10-mark question. We are left off with a 10-mark question. All right, we are left off with a 10-mark question. What does the examiner wants us to do? He wants us to explain the revenue treatment. Okay, the revenue treatment as per IFRS 15. Okay, he wants us to explain the revenue treatment of IFRS 15. Okay. Simple, no problem. We can do it. We can do it. What does he want? Revenue of internet service, right? Also, he wants revenue of sale of equipment. You all include these only, guys. If you all include these two only, you all will be able to get that 10 marks, right? You all need to include these two to get that 10 mark, right? You all need to explain in terms of revenue of internet service, they have sold internet as well as they have sold equipment, right? You are going to speak about that related to IFRS 15. You all will be able to get 1 mark, sorry, 10 marks, sorry. Okay. I hopefully that you all are still with me. Right? Hopefully you all are still with me. Uh, don't worry. Don't worry. This is a simple question. This is a simple question. You all can easily attempt this. You all can easily attempt this. Right? So here it is. On 1st January, they have gone and entered a contract with CFO, right? To provide internet for 2 years. To provide internet for 2 years, right? Obviously, obviously, you all need to understand. You all need to understand service is recorded over the time, right? Or over 2 year time period, right? If it's a good sale, guys, or if it's goods that is being sold, that good will be recorded when the control has been passed, right? Or at a time. But since this is a service, this is a service of 2 years, right? This will be recorded over the time. This will be recorded over the time, right? This is what you all need to understand, right? Also, here see the contract price was agreed at $2 million, right? Which was received in full on 1st January 2006. My question to you all, my question to you all, can I record this entire 2 million? Can I record this entire 2 million on 1st January 2006 as revenue? No, I can't. No, I can't. Why? Because this is for 2 years. This revenue is for 2 years. So what I need to do is I need to make sure I need to split this 2 million, right? 2 million. I need to split it by the 2 years and find out what is the revenue for 1 year, right? From 1st January to 31st December 2006 is 1 year, right? I cannot revenue recognize this entire 2 million. Why? Because this entire 2 million is for 2 consecutive years, right? Because we are going to provide services for 2 years, right? So because of that, what I need to do is I need to only show revenue for my current financial period, right? Current finance period. So your double entry would be, let's guess, your double entry would be you all receive cash, bank debit. How much did you all receive? You all receive 2 million. Revenue would be revenue would be 2 million divided by 2 years is equals to 1 million is your revenue. So what would be the difference? What would be the difference? What would be your difference? What would be your difference? Obviously, that is income received in advance. Income received in advance, which would be 1 million, right? The entire revenue of 2 million cannot be recognized as revenue because this cash has been received for 2 years. This cash has been received for 2 years. Okay, so you all need to proportionate. You all need to proportionate. Any excess amount that is being received, any excess amount that is being received has to be recorded under income received in advance, right? Income received in advance. Okay. So this point relates to equipment, right? We can start writing for the internet service. We can start writing for internet service. Okay. Obviously, this is IFRS 15, right? What does IFRS 15 states, right? Normally, I have a habit, guys. Not only me, all of us will have a habit, right? We will start off with a general point. If we know that standard very well, IFRS 15 has been always tested. So what I want you all to do is start off with the standards general point. Here see, IFRS 15 states. What does it state? Revenue will be only recognized, right, when the performance obligation is transferred to the client, right? Or when the control performance obligation slash control, right? When your performance obligation or control is transferred, obviously then only customer has the risk and reward. Because of that, then only you can recognize revenue, right? In this particular scenario, this can be at a point of time or over the time, right? This is at a point of time or over the time. You all can record revenue, right? Here, see now bought in internet services, right? And here, see these are the points. Internet services will be recorded over 2 years. Why over 2 years? Why over 2 years? Right? You all need to know the conditions, right? You all need to know the conditions of over the time, right? There are three conditions, guys. If either one of those are met, you all can record it over the time. You all can record it over the time. If either one of those are met, you all can record it over the time. Okay. I guess, guys, we have done it multiple times. So I want you all to think. I want you all to think and tell, right? I want you all to think and tell what is that? What is that element of that condition that is being met? What is that element of that condition being met? All right. That is known as, guys, can you see here? Over the 2 years, over the 2 years, customer will be able to simultaneously consume, right? He'll be able to simultaneously consume and benefit over the given time period. What does this mean? 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 Obviously, what does this mean is, see, he's taking that particular service for 2 years, right? He's taking that particular service for 2 years, right? So what he can do is, over the entire 2 years, he can call, he can chat, he can connect to the internet, right? So why? That he will be able to get the benefit as he consumes, as he uses his mobile phone or as he uses that particular internet service, he's able to benefit. How is he able to benefit? He's able to speak to his girlfriend, he's able to play games through the internet, right? He's able to chat with his friends on WhatsApp, he's able to consume that, he's able to use the internet service, right? And simultaneously benefit from them. By using his internet service, he's able to speak to his girlfriend, he's able to chat with his friends on WhatsApp, and he's able to play games, right? This is how you simultaneously benefit. This is how you simultaneously benefit, right? And now I come to tell here, see, I do not recognize the entire 2 million. I will only recognize 1 million, right? 1 million in the current financial period. What would happen to the remainder? What would happen to the remainder? That is income received in advance. Okay, income received in advance is a current liability. It is a current liability. Why? Sometimes you all need to repay it back. Sometimes you all need to repay it back. It's a current liability. That is what I mentioned here. Here, see, bank account debit 2 million. Revenue only will record 1 million. And 1 million would be income received in advance. 1 million would be income received in advance. Okay. So what I want y'all to do is always go and y'all don't need to memorize. Y'all don't need to memorize any standards, right? Learn the standards. Learn the standards. Okay. Just learn it in a way where y'all could, understand. Right. Try to be always practical. Right. Consume simultaneously and benefit simultaneously is obviously you all are able to use it. Consume the internet service and speak to your girlfriend, right? And by speaking to your girlfriend, obviously, you all can benefit, right? It's a long-term relationship. Never forget. Okay. Now, finally, we are left off with the equipment, right? With the equipment. Summary of internet services. Okay. Speak about, again, I'm telling you all, speak about whether it's recognized at a point of time or over the point of time. If so, why? Right? And speak about the revenue. Do you all recognize the entire revenue or only the revenue until the current financial period? If that is so, what would happen with the remainder? You all need to speak, right? So you all will be able to get some marks. You all will be able to get some marks. Here, see, 4 marks is being allocated for internet services. 4 marks is being allocated, right? 4 marks. And the remaining 5 marks is towards equipment. The remaining 5 marks is toward equipment. Let us go and read equipment as well. Let us go and read equipment as well. Okay, here it is. Let me use another color. At the same date, Jacinta Co. sold equipment, right, at fair value, right? Obviously, many all know goods and good is being sold, right? Good obviously will be recorded at a point of time, right? When your risk and reward or when the control is passed, right? At a point of time, you can record that revenue. Okay. At the end of the internet service contract, right, on 31st December 2007, Siaco has the right to return the equipment to Jositaco and receive 20,000. Hmm. Seems different now. Seems nice. Something nice. Okay. So what does the condition say? Right? What does the condition say? I will sell you this equipment. Alright? I will sell you this equipment, but what I want you to do is I want you to give it back to me. I want to sell it back to me. I want you to sell it back to me. Right? I wanted to sell it back to me. Don't worry, I'm not going to take it for free. Don't worry, I'm not going to take it for free. I will give you 20,000 after 2 years. I'll give you 20,000 after 2 years. Right? Can you see here? He is selling off with a condition. Sale and repurchase with a condition. Can you see here? Can you see here? He is selling, now I will sell it to you. But what you want, I want you to promise is, please, you need to return it back to me. You need to return it back to me. Don't worry, I'm not going to get it for free. I will give you $20,000. Right? That is what he's saying. That is what he is saying. Right? I will sell it off now. On 1st January, I'll sell the equipment. Right? It can be a Wi-Fi tower. Say it's a Wi-Fi tower. Right? That Wi-Fi tower, they are selling it off now for 500,000. But they need the buyer to again sell it back to them. They need the buyer to again resell it back to them. Don't worry, it's not for free. They will give 20,000 worth of cash. Right? Jacinta Co anticipates that the equipment's fair value, the market value, right? The market value in 2 years' time, right? The market value in 2 years' time will be 75,000. Will be 75,000. So now I want you all to use your logical sense. I want you all to use your logical sense. See, see the market value, right? The market value in 2 years' time of that asset is 75,000. Okay. That means that seller, right? That that buyer in 2 years' time, he can sell it to another party and get 75,000, right? And what you're planning on doing, you as a company, you're only planning on giving 20,000. Where do you think this buyer would go? Where would you think the buyer would go? Here it is. Let me plot it on a graph. The buyer is currently buying, right? What he has is he has two options. He has two options. One is to sell it to you, or one is to sell it to other party, third party, right? Third party, or he can sell it to you. If he sell it to you, you will only give him cash of 20K, right? If he sells it to a third party would give a cash of 75,000, 75K. Where do you think is ideal? Where do you think is ideal? Obviously, right? Wherever I get the highest amount, he is the person I am going to sell. Wherever I get the highest amount, he is the person I am going to sell, right? So obviously that buyer will not resell it back to us. Why? Because we are only giving 20,000. Meanwhile, another third party is giving you 75,000. So obviously I will sell it back to the third party. I will sell it to the third party, not to you. I'll sell it to the third party, not to you, right? So this is what you all need to know. This is what you all need to know. This sale, right? You all are going to repurchase, but there is a condition, right? I will repurchase at 20,000. But you all need to think it from the other party as well. You all need to think it from the buyer's perspective as well. Buyer in 2 years' time, you will be given 20,000. but there's another party who's willing to give 75,000 and market value. So obviously, where will he go? He will go under 75, right? He will go under 75. He will go and get the highest offer, right? Let me write that also. Highest offer, right? Highest offer. And another point is here it is. The market for second-hand equipment is very strong. Very strong means, guys, there are large number of buyers, right? There are large number of buyers. That is what the second-hand very strong means, right? Large number of buyers, right? There's a large number of buyers. That is why very strong. So this person does not need to be scared. He does not need to be afraid at all. Why? Because there are multiple people who are willing to quote or who are willing to buy at $75,000, right? There are multiple people who are willing to buy them at $75,000, right? That's why they mean it as strong, right? Second hand equipment is very strong. So CFO would be able to sell the equipment easily at the end of 2-year agreement, right? You're not the only buyer. You have third party people who have strong demand, right? Who are willing to pay $75,000. Okay. And also Jacinta Code does not want to deal with the second hand equipment and therefore always prices the equipment returns at a substantial below fair value. Oh, that does not make sense. CFO has never returned equipment in the past. Okay. So what do you all think? What do you all think? Are you all able to handle it? Are you all able to handle it? What is happening is, guys, simple, right? What is happening is simple. They are selling off this asset. They are selling off this asset for 500,000. It's a sale, right? It's a sale of good, right? It's a sale of a product. Many all are selling off the product, right? You all can recognize at a point of time, 500,000. Right? When is the sale being taken place? On 1st January 2006. No problem. But I told you all, if you all need to consider it as a sale, if you all need to consider it as a sale, right? You all need to make sure that the risk and rewards or the control is transferred, right? In this, what is happening? They are putting a condition. I will sell you now, but I need you to repurchase it back. I need it to repurchase it back. Don't worry, I will not get it at free price. I will give you all 20,000. I will give you all 20,000, right? But the other company who is CFO or who is the buyer, right? He can get another offer of 75,000 for second hand market, right? He can get $75,000 from a second hand market. So obviously, and plus that second hand market is very strong. That means there is multiple buyers who are willing to give 75,000. So obviously he'll compare 75,000 and 20,000, which is worth, that is where he will go, right? And also here see, Sieko has never returned equipment to Jacinta Co, right? In the past, right? So that means I guess he has always been accepting this option of 75K, right? Why? Because you see, they always value the equipments below fair value. Can you see here? Obviously, right? When I can get 75K from another person who has large number of buyers, why would I go and give it to you all? That is it. So if you all discuss these with proofs, with appropriate proofs, you all will be able to get your marks. With those appropriate proofs, you all will be able to get your marks. Okay, here see. How would I start? How would I start? In terms of equipment, they can book the revenue at a time. Obviously, right? At a point of time, right? For $500,000. But they have made a condition. Obviously, right? What I mean is, since these are good, right? Good can be recorded at a point of time for how much? $500,000. But what's the condition? What is the condition? Spearco, right? Spearco has a right to return the equipment and receive $20,000, right? Don't worry, we are not going to buy for free. I will give you $20,000, says Jacinta Co. Right? Says Jacinta Co. Okay. Is this at market value, guys? Yes, see, when market is offering at 75, you're only giving at 20,000 after 2 years, right? Which is below the market value, which is below the market fair value. Okay. So that's unfair, right? That's unfair, right? That's unfair, right? Wherever I get the best offer, I'm going to go there. I'm going to fall there. I'm going to fall there, right? So here, see, once the product is transferred, the risk and rewards are with the consumer, right? Obviously, if I need to record revenue, right? If I need to record revenue, I need to make sure that the risk and rewards are with the consumer, right? I need to ensure that my risk and rewards are with the consumer. Here, see, this says, here, see, he has a right to return. See, I need to make sure if I need to recognize revenue, guys, the very first step is I need to make sure that the risk and rewards are transferred. After that, only I can go and recognize at a point or over time, right? Okay, that is what you all need. And here, see, you all are putting a condition. I'm going to rebuy it, but I'll buy below the market price. I'll buy below the market price. Now comes the argument, or now comes the justification. Justify. Justification one. You see how I'm justifying. See, when the market of the second hand is 75K, right, and you resell it back for the company for 20K, right, this will be an unwise decision. Obviously, right, he can easily sell it for 75K in outer market who has large number of buyers, right, rather than selling it to you. From the customer perspective, it is a loss for them. Obviously, right, it's a loss for them. Rather, I mean, they are losing out how much of money, right? It's not a small amount, right? That is one number justification number one. Okay, justification number two. Okay, justification number one is when obviously they can sell it out to people, right, at 75K. Why would they go and sell it for you, right? Why would they go and sell it for you? Justification number two. Since there is also an active market, right? Obviously, large number of buyers, right? He could easily sell it off. Okay, he could easily sell it off. Therefore, we could conclude based on the active market and the past data and the past data. What does this mean? Here, see, based on the past data, guys, Siaco has never returned equipment, right? Siaco has never come and returned equipment. That means what they try to mean is, guys, always they are going for the market value rather than going for your value, right? That is what I try to mean here. They are always going as market value, right? They never choose your option. Why? Because your option is not favorable to them. Your option is not giving more profits to them. Okay. So therefore, we can book revenue. How can we book revenue? Let me confirm that to you all. How can I book revenue? Let me confirm that to you all. Let me confirm that. How do I book revenue? Obviously, the risk and reward is being transferred. Obviously, the risk and reward is being transferred. Why? Because the customer is not going to return it back to me. The customer is not going to return it back to me means the rewards and the return are with him ideally, right? He's not going to return here. See, customer will only return his risk and reward when there is a favorable position, right? When there is a favorable position. But in this, by me giving him only 20,000, do you think he'll come and return to me? No. And his past behavior also says that he's not going to return. So therefore, we can conclude that the risk and reward is transferred to the customer, right? He is only bearing the risk and reward. Why? He's not going to return it back to me. He is not going to return it back to me. That is what. So therefore, we need to recognize revenue. Okay, that is why we need to recognize revenue. Here, see, relate it here. Okay, right. right? And also you all you see also companies, the Jacinta Co is also sharper, right? They are also, they also try to get at relatively less price to create more profits, right? Obviously they would not try to buy an old asset for market value. They'll start bargaining, they'll start negotiating. So that is what I meant here, right? And finally finally from the company perspective, do you all need to book a liability? Do you all need to book a liability? See, you all have promised, right? Under condition, saying that you all will be giving 20,000. Do you all need to book a liability? Do you all need to book a liability? That's what I have written here. Do we need to book a liability? Do we need to book a liability of 20,000? I don't think so. Yes, it's unlikely. I don't think so. There is no requirement for me to book a liability. There is no requirement for me to book a liability. Why? Why? It is quite simple, guys. It's quite simple. Why don't I need to create a liability? Wait, I'll show you. Do I need to create a liability? Yes or no? No. Why? Obviously, because based on my past patterns, based on my past patterns, and based on the active market that is available, right? That person is not going to buy at 20,000 at all, right? He is not going to buy at 20,000 at all. Then why do I think, do I need to create a liability? Do you all get my point? Do you all get my point? See, if I need to create a liability of 20,000, right? If I need to create a liability of 20,000, that transaction needs to be probable, right? That transaction needs to be probable, or it needs to happen, right? But based on this past transaction, they have never come and bought. And also, when they can get 75,000 in the market value for a second hand equipment who has strong or large buyers, they don't come to us. They are not going to come to us. So, therefore, that transaction is not probable. Not probable. So, no provision, right? So, no provision at all. So, no provision at all, right? This is it. This is it. If you all mention all of this, right, you all will be able to get your marks. Don't worry. Don't try to aim for the entire 10 mark, right? Don't try to aim for the entire 10 mark. Explain this in a way that examiner understands, right? Examiner understands. You use the proofs, right? Try to relate it to the scenario as much as possible, right? Bring in these names, Jacinta Co, Siaco, the dates, right? The appropriate dollar figures, right? Bring in the dates, the dollar figures, and have a proper methodology, right? Look at this. The way I gave it to all was, this time I did not prepare myself because I was right after office. I did not have time to prepare. I just jot down points. You can now see here, but make sure that you all give them, right? Make sure you all give them. So here, see, I could come up with a conclusion. Conclusion. What would be my conclusion? Record 500K at a point in time on 1st Jan 2006, since due to the above factors provided, right? This is why, right? This is why. This is it, guys. This is it. This is it. This is it. Okay. There's another last tip that I need to give out. There's a last tip that I need to give out. Let me give that also. Let me give that also. Otherwise, I don't think I could sleep today. Right? Because I don't think I could sleep today. Okay. Here it is. Here it is. Can now see here. Can now see here what I have mentioned here. When the repurchase value is greater than the market value. Okay. When the repurchase value is greater than the market value. Both of these, I want you to look in at the perspective of customer point. I don't want you to speak from the perspective of the company point. I want you to speak from the customer point, who is Spearco. who is peer group, right? See, let me take this. When the repurchase price is lesser than the market value, here it is. You see, you're planning on repurchasing it at 20,000, right? While the market is planning on giving it at 75,000. Do you all think, do you all think the customer will buy this or customer will consider a repurchasing option? Will he consider your repurchase option? No, right? He will not reconsider. Why? He can get 75,000 from a market. Why will he go and sell it for all to 20,000? So that is known as a final sale. Why? Risk and reward is transferred. Right? This is a very important point, guys. This is a very important point. This is a very important point. I don't want you all to skip this, right? Skip whatever you all want, but don't skip this, right? Skip this. Don't skip this at all. Can you see here when the repurchase value offered by the company is lesser than the market value, according to this question, right? We are giving 20,000, market is giving 75,000. Obviously, customer would like to get the market value rather than yours because it's not worthy, right? So what? Then this is obviously a final sale. Why? He is not going to return it back to us. The risk and the reward is with the customer. He is not going to record. He is not going to reward. He is not going to sell it back to the company. Right? Obviously, he is not going to sell it back to the company. Why? He can sell it to another party and gain money. Right? Another instance. You're giving him 90,000, right? Which is greater than the market value. Market value is only 75,000. Obviously, now, can you see here? He is getting higher compensation, right? He is getting higher repurchase price, right? Here, see, you all are offering 90,000 for a 75,000 market value asset, right? Then, obviously, this needs to be treated as sale and lease back. This needs to be treated as sale and lease back, right? This is the accounting treatment, guys. This is the accounting treatment. Okay. When your repurchase price is 20,000 and the market is giving 75,000, obviously he will sell it to the market, right? So then that is a final sale. Why? Risk and rewards has been transferred. Okay. He's not going to sell it back to the company. But when you're going to give 90,000, right, which is above the market value, obviously he will look at the higher compensation, right? You're giving the higher price. You're giving the higher price. You have quoted the higher price. So he will consider, you need to consider them as a sale and you will lease it back. You will lease it from him itself. You will lease it from him itself, right? You will lease it from him here, right? Uh, Hopefully all have understood, guys. Today the day has been very hectic. I mean, sorry, yesterday was a very hectic day, so I could not prepare much. I could not prepare much, right? I have only given out some of the points. So what I would request you all to do is, first do these standards. First do these standards, right? After that, uh, do the standards, right? Study the standards. Do this question on your own, right? Or send it to me. I'll try to mark them and I'll give it to you all, right? And also try to grab on points from the examiner's kit as well, right? But I would not recommend this. I will not recommend this. If you all want, you all could use it. Okay. If that is so, have a very good night, right? Stay safe. Hopefully, we will meet in our very next session, right? If you all have any doubts, let me know. We could discuss over it, right? Thanks. Thanks for watching, guys. See you all then.